You're about to join into the world of systematic market cycles. Learn the most dependable and consistent, yet often overlooked investment strategy. Welcome to the Technical Intrinsic Value Podcast.
Imagine buying into a company that is just fundamentally flawless. I mean, revenues are exploding.
Right. They're opening new locations at an absolute breakneck pace.
Exactly. And every single financial analyst on Wall Street says it's an absolute sure thing.
It's a lock.
Yeah, a lock. So, you buy in heavily. And then over the next 12 months, you just watch in horror as you lose like 40% of your capital.
It's the ultimate trap.
It really is. Welcome to the Technical Intrinsic Value Podcast and to our deep dive into the source material. Today, we're exploring why the financial news cycle often feels like this sophisticated trap designed to separate you from your money.
And more importantly, how you can learn to read the hidden mathematical rhythm of the market instead.
Right, because we are targeting the specific anxiety that comes with late cycle market pressure. You know that feeling?
Oh yeah, where you're staring at euphoric headlines on a Tuesday.
And then dealing with a terrifying, unexplainable portfolio drawdown on Wednesday.
That anxiety is incredibly common among retail investors right now. And honestly, it stems from a fundamental misdiagnosis of what the market actually is.
Let's unpack that a bit.
Well, when you're constantly reacting to the surface noise, right? The upgrades, the downgrades, the macroeconomic panic, you're missing the underlying structural geometry that actually governs asset prices.
And shifting that perspective, that's our singular mission for this deep dive today. We're going to decode that hidden architecture.
Yeah, we have some incredible source material to go through.
We do. We're pulling heavily today from a brilliant series of articles titled Taking Market Cycles to the Next Level. But before we jump into the mechanics, I need to lay down a really clear foundation for you, the listener.
Very important disclaimer here.
Right. All the analysis, the models, the specific strategies, and the market views we're discussing today, they reflect the work and the philosophy of Nicolau Primavera Carvalho. He is the author of this article series and the creator of the proprietary technical intrinsic value model.
Which we'll just be referring to as the TIV model as we go through this.
Yes, the TIV model.
And the TIV model is just a remarkable piece of analytical architecture because what Nicolau has accomplished here is, well, it's the complete removal of subjective emotional bias from the investment process.
It's all math.
Exactly.
Yeah.
The methodology completely replaces the traditional reliance on media narratives with this rigorous, purely data-driven cycle analysis.
Which is exactly what we're applying today.
Yeah.
So here's our roadmap. First, we're going to examine the terrifying market chaos of 2008.
To really understand how a mathematical rhythm operates beneath total panic.
Right. Then we're going to dissect a company you almost certainly know, Chipotle, ticker symbol CMG. We'll see how explosive fundamental growth can entirely mask structural exhaustion.
That case study is mind-blowing.
It really is. And later, we're going to unveil a mystery company, Bio-Techne, ticker symbol TECH, which has just survived this brutal, agonizing multi-year correction and is sitting on the precipice of a massive new phase.
Yeah, and just to note, while this episode focuses closely on Chipotle and Bio-Techne, the article series covers several others, which we'll explore in our next deep dive.
Yeah, definitely tune into the next one for those. But the contrast between these two today, Chipotle at the absolute zenith of its euphoria, and Bio-Techne emerging from the ashes of a multi-year washout.
It provides a perfect masterclass in understanding how capital actually rotates through these mathematical sequences.
So let's start by addressing this concept of a market cycle. Because the traditional understanding of a business cycle, the expansion, the peak, the contraction, the
trough. It's so often too macro.
Right. Too slow to explain the vicious volatility we see in individual stocks. I mean, everyone learns in Economics 101 that an economy expands, unemployment drops, the engine overheats, inflation spikes, and a contraction is forced.
Like clockwork.
But when we look at individual equities, the stock market cycle doesn't just neatly mirror that macroeconomic business cycle. It seems, supercharged, distorted.
Well, the distortion comes from the injection of human psychology.
Okay, break that down for me.
So a company's stock market cycle is tethered to the underlying business cycles, certainly. But it's violently amplified by investor sentiment, by liquidity flows, and valuation premiums.
Meaning people get greedy.
Exactly. During a fundamental expansion, a company is generating real rising revenues. But as that confidence compounds, rational investment transforms into irrational euphoria.
Investors stop paying for the company's current reality.
Right, and they start paying massive, unjustifiable premiums for a theoretical future that may never materialize.
So, to translate this for maybe a novice investor listening, the peak of a stock cycle isn't necessarily when the company stops growing its earnings.
No, not at all.
The peak is when the valuation becomes entirely decoupled from reality.
That's the danger zone.
And when that contraction inevitably hits, it isn't just a slight adjustment in the price-to-earnings ratio. It's like a violent collapse in sentiment. Think of it like the seasons. Markets have a winter, which is a correction, and a spring, which is a new wave.
And that winter is violent precisely because the premium was built on emotion, and emotion evaporates instantly.
It just vanishes.
Yeah. To understand this structurally, we have to look back at the 2008 financial crisis. If you were managing money or even just watching the news in 2008, the visceral experience was one of absolute unmitigated chaos.
It felt like the sky was falling.
Major institutional pillars were vaporizing overnight. The housing market, which culturally was perceived as completely impenetrable.
Safe as houses, right?
It was it really felt like the mechanics of capitalism were fundamentally breaking.
But that blind spot, the inability to see anything but chaos during a macroeconomic trauma, that's the exact same psychological blind spot that causes retail investors to get crushed by euphoria at the top of a cycle.
It's two sides of the same coin.
Exactly. Because when I read Nikolau's analysis of 2008 through the lens of the TIV model, it totally reframed the entire event for me. He doesn't view 2008 as an anomaly or like a glitch in the matrix.
No, he views it as a deeply necessary, mathematically scheduled reset.
A scheduled reset? That is wild.
And the mechanics of that reset are crucial to understand. So the global market had completed a massive multi-decade growth cycle.
Right.
The internal structure of that cycle was violently bloated. Toxic mortgage-backed securities, unsustainable leverage, extreme overvaluation across multiple asset classes.
That's rot everywhere.
Exactly. In the framework of the TIV model, a crash of that magnitude is a biological function of the market. It's a necessary trough designed to forcibly liquidate the rot, clear the system of systemic overleverage, and create the baseline structural conditions required for a new expansion to even exist.
Okay, let's unpack this. Because using traditional investing logic here is like sailing in a storm without a compass, right?
Absolutely blind.
But the TIV model is like having a precise tide chart. It measures that biological function by mapping the psychological and valuation journey of an asset using a very specific 5-wave sequence.
The 5-wave structure is the core of it.
Yeah, and I want to get away from the simplistic analogies here and talk about the actual capital mechanics of these waves. Wave 1 isn't just a quote-unquote new beginning.
No, it's an inception point.
Right, emerging directly from the despair of a massive crash. It's the phase where the smartest, most calculated institutional money begins quietly accumulating an asset that the retail public currently disguises.
And the volume profiles during a wave 1 are fascinating because they are often so subdued.
Nobody's talking about it.
Right. The public is terrified reading headlines about the lingering effects of the recession, while institutional capital is building a massive foundation at deeply discounted valuations.
And then comes wave 2.
Yeah, wave 2 is a secondary structural test. It's a pullback that shakes out the remaining weak hands who bought the absolute bottom but lack the conviction to hold.
They get scared and sell. And once wave 2 completes, we enter wave 3.
The sweet spot.
Yes. This is the longest, most powerful advance in the sequence. It's where the underlying fundamentals of the business, the exploding earnings, the widening margins, they finally align with mass institutional buying.
The trend becomes undeniably upward, and you start to see the broader public slowly recognizing the momentum.
But then the architecture fundamentally changes when we reach wave 5.
Yeah.
And this is the definitive end of the trend.
The mechanics of wave 5 are incredibly dangerous because this wave is driven almost entirely by retail FOMO, the fear of missing out.
Just pure greed.
Yeah. The institutional capital that accumulated during Wave 1 and drove the momentum in Wave 3, they begin quietly distributing their shares.
They're selling to the euphoric retail crowd.
Exactly. Wave 5 is characterized by a complete detachment from fundamental reality.
Which raises a big question. If the rhythm is so predictable, why do so many smart retail investors get crushed at the end of a cycle?
Because relying on traditional narratives in Wave 5 is financial suicide. We live in an era where financial media is designed to keep you engaged, not to protect your capital.
That is so true.
Every talking head has a thesis about a genius CEO or a revolutionary new supply chain dynamic. But the TIV model ignores all of it. It uses mathematical geometry to filter out the noise. If the structure of a Wave 5 is complete, the model dictates an exit, regardless of how charismatic the CEO is on television that morning.
Because narratives are retrospective. By the time a bullish narrative is universally accepted and dominating the front page of financial websites, the structural opportunity has already been extracted.
The math only cares about the completion of the psychological sequence. It measures the decay of momentum and the distribution of volume.
Okay, let's bring this into a concrete reality. Because there's no better example of extreme public euphoria masking a structural market top than Chipotle Mexican Grill, ticker CMG.
Oh, this case study is legendary.
The execution of the TIV model on Chipotle is one of the most stunning examples of cycle analysis I have ever seen documented. I want to trace this journey starting from the very foundation.
Let's do it.
So the TIV model identified the bottom of a Wave 2 correction for Chipotle, the absolute perfect mathematical setup for a massive Wave 3 expansion.
Yeah.
And it signaled an entry on August 1st, 2018. The price of that entry was a split-adjusted $8.70.
Just incredible. To put that in context, in 2018, Chipotle was still fighting through immense negative public sentiment.
Oh yeah, the food safety issues.
Right. They were dealing with the lingering reputational damage. The public narrative was incredibly bearish. Analysts were questioning if the brand could ever recover its former glory.
But the math didn't care.
Exactly. The mathematical structure showed that the Wave 2 washout was complete. The institutional accumulation was beginning. The model signaled the entry entirely irrespective of the negative headlines.
And that $8.70 entry was the inception point of a generational run. But look, the true test of a methodology isn't just catching a bottom.
It's having the discipline to recognize the mathematical peak.
Yes. Fast forward nearly 6 years. The TIV model tracked Chipotle through the massive Wave 3 expansion, navigated the Wave 4 consolidation, and rode the absolute parabolic euphoric spike of Wave 5.
What a ride.
And then the model calculated the completion of the cycle. It fired a mandatory exit signal at the absolute peak of Wave 5 on June 17, 2024, at a price of $66.07.
The magnitude of that trade execution is just staggering when you compare it to passive traditional investment strategies. That specific cycle-based trade generated a 659% return over nearly 6 years.
659%.
Yeah.
Which completely obliterates the broader market. I mean, if you had parked that same capital into the S&P 500 index over that exact same time frame, you would have secured a 92% return.
Which is historically a fantastic return for an index over 6 years.
It is, but a 659% return is life-altering capital appreciation. It's an outperformance of more than 6-to-1 against the benchmark.
And the exit is where the underlying mechanics of the TIV model truly distinguish themselves from traditional fundamental analysis. We have to discuss how the model knew it was time to evacuate a stock that appeared, to the rest of the world, to be an unstoppable juggernaut.
Right. Nicolau Carvalho describes a crucial concept here called intrinsic divergence. Let's drill down into the mechanics of intrinsic divergence, because this is the invisible killer for retail investors.
It really is.
The average investor looks at a simple line chart, sees the price moving from bottom left to top right, and assumes everything is perfectly healthy.
Yeah.
But intrinsic divergence is happening beneath the surface.
Exactly. Intrinsic divergence occurs when the surface price of the asset is pushing to marginal new all-time highs, but the internal structural wave patterns and momentum indicators are showing severe exhaustion.
You can actually see this mechanically if you know what to look for, right?
Yeah. The price might be higher today than it was a month ago, but the trading volume driving that upward move is plummeting. The institutional capital flow has shifted from aggressive buying to quiet distribution.
They're sneaking out the back door.
Exactly. The geometry of the trend is internally breaking down, even as the price prints a higher number on the screen.
I look at intrinsic divergence like a massive skyscraper being built. From the street, the public sees the building getting taller every week, adding new floors of glass and steel. They think it's a marvel of engineering.
But the structural engineers,
The ones looking at the internal stress tests, right? They can see that the foundation is cracking under the immense, unsustainable weight. The building is still going up, but the collapse is mathematically inevitable. The price is peaking, but the internal structure is entirely compromised.
and what makes this so incredibly perilous for the retail investor is the environmental noise surrounding a Wave 5 peak. In June 2024, at that $66.07 top, the environment around Chipotle was pure, unadulterated greed.
It was deafening. Every single headline was about their fortress-like bland loyalty. The financial press was relentlessly pushing stories about their unstoppable digital growth.
Oh, and the Chipotlanes?
Yes, Wall Street had seemingly fallen in love with Chipotlanes, their dedicated digital drive-thrusts, framing them as this infinite margin expansion glitch. You had analysts tripping over themselves to upgrade the stock, raising their price targets week after week just to keep up with the parabolic price action. The stock felt completely invincible.
That environment is the ultimate emotional trap. At the zenith of Wave 5, FOMO takes the wheel. The retail investor's discipline is completely drowned out by the roar of the crowd.
Social proof is so powerful.
It's a biological driver. When your neighbor is making money and the financial television anchors are laughing about how easy it is to own the stock, standing apart from that crowd feels unnatural.
So here's where it gets really interesting. I constantly think about the psychology required in that exact moment. If an investor is sitting at their desk in June 2024, reading universally positive earnings reports, seeing institutional upgrades, and watching the price tick higher every morning, how does a retail investor find the courage to hit the sell button based purely on a structural wave model?
It requires a profound shift in how you view market information. You find the courage by understanding that the market is a highly efficient forward-looking mechanism. It has already priced in the perfection of the Chipotlane strategy.
It's baked in.
Right. It has already priced in the digital growth. By the time those narratives are dominating the mainstream, the smart money, the capital that entered at $8.70 during Wave 1, is actively using that euphoric news cycle as liquidity.
They need you to buy so they can sell?
Exactly. They need that massive wave of retail buying pressure to absorb their massive sell orders without crashing the price immediately. You trust the math over the narrative because you recognize that a completed mathematical cycle exerts a gravitational pull that no amount of positive press can overcome indefinitely.
And that mathematical truth is incredibly cold. A completed 5-wave cycle demands a significant, prolonged correction. It isn't a suggestion. It is a structural prerequisite before a new cycle can even begin to form.
It has to happen.
And it did. After the TIV model signaled the mandatory exit at $66.07, the reality of that completed structure set in. By September 2025, when Nicolau published his analysis, the stock had plummeted to $39.81.
A catastrophic drawdown of nearly 40%.
And think about who took that loss. It was the investors drawn in by those euphoric Wave 5 headlines. They bought the growth story at the exact moment it was already fully priced in, and they were left holding the bag as the internal geometry decayed and the stock collapsed.
The recognition of this structural inevitably, though, leads a lot of sophisticated or perhaps overconfident retail investors to a very dangerous conclusion.
The shorting trap.
Yes. When they learn that a completed Wave 5 virtually guarantees a massive 40 or 60% correction, their immediate instinct is to aggressively short the stock.
Which introduces a whole new level of psychological and mathematical danger. I want to be incredibly clear about this, because the TIV model strongly advocates against shorting a peaking stock. We need to elevate the discussion past the basic definition of shorting and talk about why it is structurally disastrous in a late-cycle environment.
The math of shorting is terrifying.
It is. When you take a long position, like when you buy a stock at $10, your maximum theoretical risk is 100%. The company goes bankrupt, the stock goes to zero, and your capital is wiped out. It's painful, but the risk is mathematically bounded.
But the mechanics of a short position entirely remove those mathematical boundaries. When you borrow shares to sell them, hoping to buy them back at a lower price, your potential loss is mathematically infinite.
Infinite loss.
Because a stock cannot drop below zero, but there is absolutely no ceiling on how high an asset can spike during a phase of sheer, irrational exuberance.
I always say, shorting a peaking stock is like standing in front of a freight train to pick up a dime. Shorting a wave 5 peak is like betting against a faulty, high-pressure steam valve. You can look at the schematics, look at the pressure gauges, and correctly deduce that the machine is fundamentally broken and must eventually explode.
Right.
But until the metal actually fractures, the pressure has no mathematical ceiling. The machine can continue building heat and pressure well beyond the point of rational design. And if you're standing right in front of it betting on the immediate collapse, the sheer force of that final irrational pressure spike will crush you before the machine actually breaks.
That is a phenomenal way to illustrate the risk. The structural exhaustion is real, but the timing of the collapse is constantly delayed by the sheer velocity of retail euphoria.
Let's look at some actual data to prove this.
Yeah, let's look at the data from our mystery company, Bio-Techne, during its previous cycle. Bio-Techne hit its mathematically calculated Wave 5 structural peak at $88.97. The TIV model recognized the exhaustion, recognized the intrinsic divergence, and fired the exit signal.
The structural cycle was unequivocally done.
But the market didn't instantly obey the math. After hitting that structural peak at 88.97, Bio-Techne experienced a final, chaotic, irrational wave of pure momentum buying. The price spiked all the way to a high of $135.95.
Unbelievable.
The structure was completely dead, the institutional money was long gone, but the blind emotion of the retail market pushed the price up another $47 per share.
So if an investor had recognized the structural top at $88 and confidently entered a massive short position, that euphoric irrational spike to $135 would have completely annihilated their portfolio.
Wipe them out.
They would have been subjected to margin calls and forced to buy back the shares at a devastating loss, right before the stock inevitably collapsed by 66%, exactly as the TIV model predicted it would.
They would have been entirely right about the macroeconomic direction, and yet utterly destroyed by the volatility.
You cannot bet against momentum when momentum has completely divorced itself from mathematical reality, which forces a critical realization for the retail investor. So what does this all mean for the listener? If we know a stock is going to drop 40%, why is just holding cash considered a win?
Because that mindset of needing to always be invested has to be reprogrammed. In a late cycle market, cash is not a passive defeated position. Cash is a highly offensive strategic asset.
Yes.
Protecting your capital during a massive post-wave 5 correction is exponentially more important than trying to squeeze a final 5% out of market top. When you exit at $66 and move into cash, you are building an impenetrable fortress around the 659% gains you just captured during the cycle.
You're stepping out of the blast radius. Sitting in cash isn't the end of the game. It simply preserves capital so you can deploy it with overwhelming force when the new structural pattern finally emerges from the ashes. You're calmly waiting for the mathematical winter to end so you can buy the exact same world-class assets at a massive discount.
And understanding how that new structural pattern emerges requires us to examine the fractal nature of market geometry. Because a completed 5-wave cycle does not just vanish into the ether, it connects to a much larger mathematical reality.
The concept of a cycle within a cycle. This is arguably the most profound insight in Nikolau's work. When an entire massive 5-wave sequence completes, like the 6-year run we saw with Chipotle, or the massive 17-year run of Bio-Techne we're about to discuss, that entire completed cycle actually becomes wave 1 of a much, much larger structure.
A grand supercycle.
Yes, a grand supercycle.
Yep.
And the brutal multi-year correction that follows that 40 or 60% bloodbath that forms the grand wave 2.
It operates on fractal logic. Just like the branching of a tree or the structure of a snowflake, the geometric pattern repeats itself identically at every scale. A massive 17-year market cycle is comprised of smaller 5-year cycles, which are perfectly constructed from smaller monthly cycles.
I visualize it like a set of Matryoshka nesting dolls. You look at the largest wooden doll, and it represents a 17-year grand wave 3. You crack that doll open, and inside, perfectly nested, is a standard 5-wave sequence that took 5 years to play out. You open the wave 1 doll inside that, and you find a smaller sequence of monthly waves. The entire market is built on this overlapping proportionate geometry.
And this geometry is deeply tethered to natural mathematical sequences. We observe this through the application of Fibonacci sequences.
Without getting bogged down in specific ratios, right?
Exactly. Without the granular ratios, the core philosophy is that market expansion and contraction do not happen randomly. They grow in proportional rhythms that mirror the organic growth sequences found throughout nature. The mass psychology of millions of investors buying and selling collectively creates a structural rhythm that obeys these mathematical laws.
For listeners who want to genuinely master this specific concept of fractal geometry, Nicolau Carvalho details the mechanics thoroughly in his book, which is also titled Technical Intrinsic Value. Specifically, he maps out this phenomenon in Chapter 5, The Anatomy of a Cycle, on page 24.
That chapter is essential reading.
It really is, and please don't forget that the book is available right now on Amazon. Understanding Chapter 5 completely changes how you interact with market drawdowns. You stop viewing a 60% market crash as an apocalyptic event and start viewing it as the mathematically required Grand Wave 2 setup for the next generational wealth-building cycle.
Which brings us perfectly to the practical application of this geometry. We've explored the theory, but now we need to look at a live environment. We need to analyze a company that has completed its massive Grand Wave 2 washout and is currently accelerating into a new cycle.
Let's do the surprise reveal. We teased it earlier. Our mystery company is Bio-Techne, ticker symbol TechS. Now that we understand how a massive completed cycle births a new one, Nicolau refers to this specific asset as the ultimate masterclass in patience.
It really is an exercise in patience.
To understand the cycle, we have to understand the underlying business mechanics, because Bio-Techne is not a consumer-facing retail brand. You aren't going to see their logo in a shopping hall.
No, they are a foundational pillar of the global life sciences and biotechnology industry. They develop and manufacture highly complex, purified proteins, specialized antibodies, and reagents.
They're providing the essential microscopic building blocks.
Exactly. Academic institutions, aggressive biotech startups, and massive pharmaceutical conglomerates rely on them every single day to conduct research, discover new drugs, and run clinical diagnostics.
I like to think of it in the context of a gold rush. Bio-Techne isn't out in the mud digging for gold. They supply the picks and shovels for the biotech industry. They are manufacturing the highest quality tools and selling them to every single prospector on the mountain. Their business model is built on high-margin consumables. They sell massive automated systems like their new Leo Western blot system, and then lock the customer into a continuous, recurring revenue stream of proprietary reagents required to run the machine.
It's a structurally incredible business model, and their historical market cycle perfectly reflects that underlying strength. Bio-Techne experienced a Grand Wave 1 that lasted an astonishing 17 years.
17 years.
The TIV model identified the inception of that cycle all the way back on October 1st, 2003, at an entry price of $7.95.
And it rode that structural wave for almost 2 decades. It navigated the smaller internal corrections until it reached its ultimate structural peak on January 20, 2021 at $88.97.
That is a 1,019% return.
It's the definition of generational wealth accumulation. But as we established, the mathematical cycle always completes. The intrinsic divergence appeared, the model fired the exit signal at 88.97, and the structural winter arrived.
And that winter was a brutal, agonizing, multi-year correction. This was the formation of the Grand Wave 2. The internal market geometry demanded a massive reset, and the macroeconomic environment provided the fundamental catalyst. The entire biotech sector entered a severe downturn. Capital just dried up.
Right. This was the widely discussed destocking cycle. During the pandemic boom, biotech companies hoarded supplies and reagents. When the boom ended, they stopped buying new materials from suppliers like Bio-Techne and instead burned through their massive existing inventories.
The fundamental revenues took a hit. And combined with the mathematical gravity of a Grand Wave 2, the stock price collapsed. It fell by as much as 66% from its peak over the next 4 years.
4 years of relentless, agonizing downward pressure. A 66% drawdown is designed to inflict maximum psychological pain. It completely eradicates the weak hands.
Anyone who bought the stock based on late cycle FOMO, anyone who didn't understand the larger structural geometry, eventually surrendered.
They just sold their shares in disgust at the absolute bottom, writing Bio-Techne off as a broken growth story.
But if you were an investor utilizing the TIV model, Your psychological state was entirely different. You had exited near the peak in 2021. You were sitting safely in cash, completely insulated from the destruction.
Watching with anticipation.
Yes, extreme, calculated anticipation. You knew this massive multi-year bleed was simply the necessary formation of Grand Wave 2. You were waiting for the math to confirm that the washout was complete so you could position yourself for the most explosive phase of the entire sequence. Grand Wave 3.
And this is where the precision of Nicolaus' methodology completely separates itself from traditional technical analysis. The model didn't just look at a 66% drop and blindly assume it was cheap enough to buy. It established a rigorous, mathematically precise threshold. Nicolaus published his analysis in September 2025, stating exactly what was required to confirm the cycle shift.
He drew a literal line in the sand. He stated that to definitively prove the Grand Wave 2 correction was over, the stock had to close out the year 2025 above the highly specific level of $51.98.
Not roughly $50, exactly $51.98.
Right. If the stock closed below that level, the mathematical structure was still broken and the model dictated staying safely in cash. But if it closed above it, the signal would fire.
The market structure delivered the confirmation. Bio-Techne closed the year 2025 decisively above the $51.98 threshold. The mathematical signal fired. The multi-year winter was officially over, and following the strict unemotional discipline of the model, an entry was triggered on January 2, 2026 at a price of $59.39.
The entry's made at $59.39, and the asset is now positioned perfectly at the precipice of a brand new Wave 1, operating as a small fractal nested inside the massive, newly birthed Grand Wave 3.
The structural alignment is incredibly powerful, and almost immediately the market began validating the methodology. Within 2 weeks of that January 2nd entry, the stock surged 17%.
But the critical discipline here is understanding the time frame of the geometry. Nicolaus makes it abundantly clear. You do not capture a 17% bounce and take profits. You are trading the inception of a Grand Wave 3.
It's a macro play.
Exactly. The previous cycle required 17 years to unfold. This new sequence is operating on that same massive structural horizon. You are securing your position for a macro-level advance, not day trading the noise.
Now, a 66% drop over 4 years would terrify most retail investors. How do you distinguish between a stock that is structurally resetting for a new massive wave versus a company that is just fundamentally broken?
That's the million-dollar question, isn't it? Because the underlying fundamental business reality always eventually aligns with the mathematical structure. The model is purely quantitative, but the real-world narrative inevitably catches up to the turn. Look at the macroeconomic shifts surrounding Bio-Techne, the exact moment that $51.98 signal fired.
It was almost poetic. Just as the mathematical structure confirmed the bottom, the industry narrative completely pivoted. The grueling biotech destocking cycle was suddenly declared over by major industry analysts. The venture capital funding that had completely evaporated during the Wave 2 winter started aggressively flowing back into biotech startups in late 2025 and early 2026.
And Bio-Techne's launch of the Leo automated system suddenly began generating massive institutional excitement.
The market always knew about their razor blade business model, but during the 66% drawdown, the psychology was just too negative to care.
Exactly. The moment the mathematical geometry shifted into a Wave 3 structure, the sentiment unlocked. The institutional capital began pricing in the massive fundamental potential again. The math leads, the structure forms, and the fundamental narrative follows to justify the new momentum.
And executing this kind of strategy, knowing the exact dollar amount that confirms a cycle shift, having the psychological fortitude to wait in cash for 4 years, ignoring the deafening media noise at the peaks and the troughs, this requires a deep top-to-bottom mastery. This isn't a casual skill set you pick up overnight from skimming a blog post. It demands rigorous mathematical understanding and deep behavioral discipline.
Which is precisely the reason Nicolaus created the Technical Intrinsic Value program.
Yeah, let's discuss the TIV program. Because listeners who are exhausted by the anxiety of the modern market are going to want to know how to build this architecture for their own portfolios. I want to emphasize that this is an exclusive high-integrity mentorship program. It is strictly limited to a maximum of 5 students.
That limitation is entirely intentional. True mastery of the TIV model requires more than just memorizing chart patterns. It requires top-to-bottom mastery of the underlying geometry, the advanced mathematics, and the strict psychological reprogramming necessary to execute the trades without emotional interference.
You simply cannot mass produce that level of mastery.
By limiting the intake to just 5 students, Nicolau guarantees that every participant receives the microscopic, focused mentorship required to completely transform their interaction with the financial markets.
If you are ready to stop reacting to the chaos and start calculating the rhythm, I highly encourage you to direct your attention to the program. You can join the waiting list right now at www.technicalintrinsicvalue.com. I will repeat that, www.technicalintrinsicvalue.com.
It represents a profound shift in how you allocate capital and manage risk.
As we summarize the practical steps for the retail investor today, the core takeaway is a complete change in posture. You have to actively step away from emotional FOMO. When you see an asset going completely parabolic and the financial press is universally guaranteeing its future success, you must recognize the high probability of a Wave 5 structural peak.
Your immediate priority must shift from wealth accumulation to defensive capital allocation.
Protect the fortress. Move to cash. Let the mathematical structure complete its inevitable multi-year correction, just as we saw with the 66% washout in Bio-Techne, and simply wait for the precise mathematical threshold to confirm the new trend.
And once that structure is confirmed, you let the 5-wave cycle do the heavy lifting. You detach yourself from the daily anxiety of price fluctuation.
I want to remind listeners again that while we focus intensely on the mechanics of Chipotle and Bio-Techne today, our next episode will continue this journey by analyzing completely different companies from the article series to uncover new facets of how this geometry applies. But before we close, for the novice listener who just checked their portfolio and realized they might be holding a stock at the peak of a Wave 5, what is the single most important practical step they can take tomorrow morning?
The absolute first step is psychological detachment. You must instantly detach your personal identity and your ego from the asset. Retail investors consistently ride peaking stocks all the way down because selling feels like an admission of defeat, or because they have emotionally bonded with the company's brand. Tomorrow morning, you must evaluate your portfolio strictly as a collection of mathematical constructs.
No emotion.
0. If an asset has experienced a massive, multi-year parabolic run and is currently the darling of the mainstream media, you must ruthlessly audit its structural risk. Secure your capital. Sidestep the inevitable gravity of the completed cycle. It is mathematically and psychologically infinitely better to exit a position a month too early than a single day too late.
Stop guessing the narrative and start calculating the structure.
Exactly.
As we synthesize the core philosophy we've explored today, it fundamentally rewrites how you should view the financial landscape. The market is not a chaotic casino designed to randomly punish you. It only appears chaotic to those who lack the framework to see the underlying architecture. In reality, it is a beautifully calculated, highly organized rhythm.
It takes the aggregate, messy human psychology of millions of participants, the collective greed, the panic, the hope, and maps it flawlessly through predictable mathematical geometry.
When you internalize the methodology of the TIV model, you cease to be a victim of the market's emotional whims. You become a calculated observer, standing firmly on the shore, watching the geometric tide, knowing exactly when the liquidity will recede and exactly when it is mathematically scheduled to return.
You step entirely outside of the emotional matrix.
Exactly. And I want to leave you, especially if you are that frustrated intermediate investor who has felt the brutal sting of buying into late cycle hype or panicking at a macroeconomic bottom, with a final lingering thought regarding the true nature of this market geometry.
This is the critical question.
If the very fabric of the market is built on these predictable fractal mathematical rhythms, if every euphoric parabolic peak and every terrifying multi-year crash is simply a necessary mathematically scheduled beat in a much larger structural sequence, then every time you feel the overwhelming urge to panic sell during a drawdown, or the desperate burning urge to chase a rising stock making new highs, you aren't actually reacting to the market at all.
You are simply fulfilling your biologically programmed role within the mathematical cycle.
You are executing the exact emotional response that the structural geometry requires the crowd to make. So the ultimate question you have to ask yourself as you approach the market tomorrow is this: will you continue to be the fuel for someone else's Wave 5 exit? Or will you do the work to become the calculated observer, patiently preserving your capital, ready to deploy with absolute structural precision at the dawn of the next Wave 1? Thank you for joining us on this deep dive into the source material. We will see you next time as we continue our journey through the mathematics of the market. Stay disciplined out there.
That's it for today. I'll see you in the next episode. The Technical Intrinsic Value Podcast is a systematic explanatory to enhance data analysis and delivery. All content logics provided herein are a direct reflection of the opinions value modeled Nicolau Primavera Carvalho. The information provided is for educational and informational purpose only and does not constitute financial, investment, or legal advice. The TIV model is a framework designed to identify patterns based on 15 years of future results. All investments involve risk. By continuing, you acknowledge you are a self-reliant investor responsible for your own execution.